All right. So this is going to be the financial statement analysis portion. This is largely, I think, going to be a review of what happened in accounting, but this just gives you a resource to go back, if you get caught up on anything. So I'm going to talk about the difference between accounting value, the book value, and then the market value of the firm. There's a difference between the way we calculate income, because of the accrual accounting, and then what cash flow would be if we did cash accounting. Talk a little bit about tax rates, going to talk about the firm's cash flow. We're going to talk about standardizing financial statements so that we make them like a common size so we can compare. And then we're going to talk about some ratios, talk about profitability and growth, and then talk about the pros and cons of doing this type of analysis. So I'm just going to start with talking a little bit about the balance sheet. The balance sheet is, as of this particular date, this is everything that we owned. That's all the assets, and this is all of the stuff that we owe, the liabilities. We start with the most liquid at the top and then work our way down to more illiquid things. So, but it's called a balance sheet because it balances the assets with the liabilities and the shareholder equity. So to see this graphically, you can kind of see how we would set this up with the assets on the left, the liabilities and the equity on the right. If you notice the difference in current liabilities and current assets, that's marked as net working capital, right? So this is the stuff that's easiest for us to work with. We don't talk about them as long-term assets. We don't want to say fixed assets, but these can be tangible things like property, plant, and equipment. And it can be intangible things like goodwill. So, so just going on from there, net working capital is the current assets minus current liabilities. When we talk about liquidity, what we're saying is how quickly can you get this into cash or a cash equivalent. So if you have a lot of cash, it's easier for you to pay debts if they were to come due quickly. So that's why we talk a lot about liquidity. And so when we talk about this debt versus equity, this is the capital structure of the firm. And so what we're going to do is determine how much of that is going to be equity and how much would be liabilities owned to the debt holders. And this is just to show you an example of a corporate balance sheet. This shows 2 different years, so you can see how it changed over time. So normally there's a lot more to a balance sheet because we go through a bit more detail. We don't just say net fixed assets, we'd break those out. But this is just to show how, we would look at, perhaps current assets, current liabilities, and then get a sense for how well they would handle some sort of disruption. So when we're talking about market versus book value is basically going to be whatever we started with if we purchased a piece of equipment minus any depreciation that it's had, which is going to be different than if I wanted to take that piece of equipment and sell it, then I would be getting a market value, right? So it's just some things to think about, what makes them different, that would be something good to think about, right? But just as I explained, the way we calculate book, obviously the market is going to value it based on some sort of utility. And so you can see some of those differences. And as far as which is more important, well, they're both important because they both have different uses, right? And so book value is easy for us to calculate. We have the least amount of chicanery or people trying to mess with the numbers using that system. But at the same time, we know that if we were going to try to liquidate, the market value is what's going to be more important. So that's the balance sheet bit. The next thing we're going to talk about is the income statement. And so the balance sheet was, as of this date, this is how it looked. An income statement is going to be over a period of time. So over this last quarter or over this last year, this is how things looked. So we start normally looking at the very top with our revenue, and then we start taking off all of our expenses, and we finally get to our net income, and that's our earnings. And so the net income, we can either keep it as retained earnings, or we can pay it out in dividends. And here's an example of an income statement. So as you see, it starts off with that net sales, and then it just starts working through cost of goods sold, depreciation, interest, taxes. And then we end up with a final net income, and then any dollar that is not paid out in dividends is retained as part of that retained earnings. A little bit to understand about the financial statements. We do this accrual accounting, but there's definitely rules around it known as GAAP, right? And so we recognize revenue when it's earned, and we match expenses that were required to generate that revenue during that period. So when we take the cost of goods sold, we're not going to charge for the entire batch. We're going to charge for the ones that were sold, right? So that's we're going to match expenses with the revenue. As far as our non-cash items, these are going to be things mostly like depreciation and amortization. And this is important because this will reduce our taxable income. It will show up, as a lower net income at the very end, but it's not cash. So when we're looking at cash flow, we're going to treat that one a bit differently. And then as far as like the fixed and variable costs, the income statement doesn't really break out, are we a capital intensive industry, which would have higher fixed costs? Or are we a labor intensive industry, which tend to have more variable costs? So you can't really tell just by looking at the sheet. You also really don't know too much about the structure of the payments. You just know that they pay this much in interest, but you don't know if that was a fixed or a variable or adjustable rate. So as far as taxes go, marginal tax rate, we'll talk about that a lot. You'll hear, marginal taxes. That means for the next dollar you make, what's your tax rate, right? And so that's generally going to be the highest tax rate that you get reached. That's normally how they go. It starts with a very low tax rate, and as you make more money, the tax rate goes up. The average tax rate is just how much did you pay in taxes divided by income. So your marginal tax rate could be 25%, and your average tax rate be 12. So it's not you would not expect those to be the same. And then if you're going to consider another project, normally with a new project, you're going to think about it at that marginal tax rate, because you're saying, look, I'm doing a new project that's going to make more money, and every new dollar I make, they're going to charge me the highest tax rate that they can. Okay. And then just to point out that the corporate tax rate became a flat rate. It's more of an issue of compliance with that one, just making it a more simple tax structure for corporations. The idea was it's just easier for them to be compliant. So this just to give an example, if we had marginal tax rate. So let's just say we had $100,000, and then we could have some tax rates. And so it would look like this. You'd start in a 10% bracket for the first amount of money. Then it would go up to 12%. But that first amount of money you've already paid taxes on, but it would be for this next amount, right? So that's why you have this difference here. And then 22%, and then 24%. And so if you see the highest tax rate is 24%, right? But the average tax rate, would be a bit lower, only at this 18.29%, right? Because it's that 18,000 in taxes divided by the $100,000, right? So the marginal tax rate is 24%, but the average tax rate's a little over 18. Okay, as far as cash flow goes, this is really just a sense for how much cash are they getting? This can be cash flow from assets. This can be thinking of operating cash flow. So there's, but what we're going to do is we're going to talk about cash flow in a couple of different ways. So in finance, one of the big things we look at is cash flow from assets. And this is basically how effective are we at generating cash flow, given that we have this much in capital tied up in our assets. And so cash flow from assets is just going to be that operating cash flow. So what was the cash flow from operations? So none of our financing stuff, right? And then we're going to have to take out the net capital spending. Now, net capital spending is going to include things like depreciation. So this is why depreciation comes up. Because if you're just trying to maintain your level of capital, you have to set aside at least as much as the depreciation just to keep those assets steady. So that's going to be subtracted off because that's cash flow that's going to be otherwise consumed. And then the changes in net working capital. Remember, net working capital is that difference between current assets and current liabilities. And so those are going to be, the more current assets you have, they're not invested, right? It's not actively engaged in making you money. And so if it's growing, then that's cash flow that's been redirected. So, but any of the cash flow from assets, we're going to pay off our creditors first. That's the interest payments that we have to make. And then anything left over is the shareholders. So necessarily the cash flow from assets is either going to creditors or shareholders. Okay, just to touch on the standardizing financial statements. Basically, all we do with standardizing our financial statements is we're going to take everything and make it a percentage of some total. So with the balance sheets, we start with total assets, and then we'll just list everything as a percent of total assets. For income statements, we're going to start with the sales revenue, because that's going to be the biggest number, and everything's going to be a percentage of that. And so what this does is lets you look at a firm year over year, or look between two firms that are closely related, just so you can see, how they're alike and how they're different. And so this is just an example using dollar figures, and it might be a little hard to compare, from year to year. But if you took those and made it, percentage of assets, then as you can see, how these numbers have changed from one year to the other. And so you can see, how that changes. And then here's the income statement. And as you see, it's listed, in these dollar figures. But then we could just do it as percentages. And then it's really easy to see which areas are really, eating into what would be a potential profit. So, and again, feel free to come back and then pause and look over these if you have any questions at all. And then again, this is like a review of the ratios that you've seen, but just kind of want to bring these back to the forefront for you. And so the first thing we're talking about, liquidity ratios. This is really just a way to say, hey, are you going to be able to pay bills if they were to come up? Right. And so that's really what that is looking at. The financial leverage ratios. This has to do with, are you going to be able to pay off your long-term debt? Right. Because leverage within finance means debt. And so that's what we're looking at is how well are you going to be able to handle these expenses as they come due. Asset management. This is all the stuff that's turnover. So inventory turnovers, accounts receivable turnover, that kind of thing. So what it is taking those assets that we have, and are we able to turn that into actual cash in hand, right? And profitability and market value. We'll look over a couple of these. So I'm going to be here just for a moment. You feel free to pause this slide, but this is just examples of these various ratios that we normally use within finance. And then using that earlier example, I'm going to just go through these and show how these ratios would work. So like the current ratio, for that earlier company, current assets divided by current liabilities. And so, this right here is saying, look, we have 1.29 times as much in assets as we have in these current liabilities. So, for the quick ratio, it's doing the same type of calculation, but you're saying, look, inventory is not something I can unload quickly. If it was, I probably wouldn't have it as inventory. I already would have sold it. Right. And so this is that quick ratio. So the short turnaround time, you see it's much lower coverage. Right. And then the cash ratio is going to be even less because we're only looking at the cash piece of that. Same types of things, total debt. So total assets minus total equity, what you're left with is total debt. So total debt divided by total assets. And this just gives you a sense for how much, is debt instead of equity. Another way that we calculate that is known as the debt to equity ratio. And then if you have 1 plus debt to equity, that's known as your equity multiplier. And we're going to use this a good bit in some of our calculations. So just understand it's 1 plus debt over equity. And that's where that leverage bit comes in. The more debt you have, the bigger this number. And so this multiplier gets bigger and bigger, right? And so I call it leverage. It's like the term in physics, using a lever to get a lot more done. So times interest earned, cash coverage. These are just a couple of other those financial leverage or the financial leverage ratios, which is really just telling you how well you would be able to pay what is due. So they earn far more before interest and taxes than they have to pay in interest. That's a good thing, that type of thing. So as far as asset management, this is all those turnover bits. So inventory turnover, this is how many times they turn through the inventory during their cost of goods sold, right? So 3.8, and then if you divide that 365 days in a year divided by the number of times that it would turn over, it tells you you have about 114 days worth of sales, right? Because it's going to turn over 3 times in a year, so that's about that long. So for some industries that would be terrible, and for others that might be okay. It just depends on the industry. So you have to be careful, not compare companies that are too different. Same type of thing with receivables. This is how well I am at collecting on credit that I've extended. And again, the days just tells you like how long are we waiting to collect. And then payables. This is sort of going the other way because this is stuff that we're going to have to pay to someone else. But it gives you a sense for how we are on our credit. And total asset turnover. This is part of the DuPont formula that we're going to talk about later, but total asset turnover is just, hey, are we able to generate sales from all these assets, right? So this is sort of like that, the sales force. I have all of this stuff and equipment to make goods for them to sell. I give them all this material to go and sell with. How many sales do they generate divided by all of those assets that I'm using to help generate sales? So, all right. And then the profitability ratios are a sense of, how profitable are we, right? That's really what this is looking at. So return on assets, return on equity. These are just looking at, hey, what is my profit given my total assets? That's why it's return on assets. Or what is my total profit divided by all of my equity, which is return on equity. And if there's any leverage, return on equity will be higher than return on asset. That's why the shareholders like it, because it ends up, that multiplier goes into effect, and then we would make more money. And then these are using market values. So earnings per share, PE ratio is price to earnings, price to sales, market to book. All of these are just ways of us going out and evaluating the company from a market standpoint. And these can be good, like within an industry, we can look at a dozen, 2 dozen firms and see how our numbers match up against our peers, right? And so this is just a way to check to see how we're being viewed in the market. EBITDA is earnings before interest, taxes, depreciation, and amortization. So we're basically just saying, hey, it's another way of saying, are we generating a market value based on what our company is actually doing? So, and this is just if you want to go back and look, just pause this and then check the other numbers, but you can see all of these. But we're going to use these here in this DuPont identity. So DuPont basically takes down what we're really looking for, return on equity, and says, okay, what's another way to formulate this net income over total equity? And so what they've said is, look, let's just look at the profit margin. So how good are we at taking net income or taking sales and turning it into net income? So you want this number to be really high, and that means you're keeping a lot of your a lot of the sales revenue that you generate ends up becoming net income, right? Now, asset use is how well we're able to take our assets and turn them into sales. And then the leverage, right, is just going to be the total assets divided by total equity. Total assets, remember, is debt plus equity. So if it's total equity plus total debt divided by total equity, that's total assets over total equity. That's why it's that 1 plus debt to equity. That's like the algebra to it. So, so profit margin, this is how well we're able to take our sales and turn them into profit. Asset use is how we're able to take all of the assets on the book and turn them into sales. And then leverage is how that multiplies for higher profit for the shareholder, right? So, okay, and then here's like the same bit. So, so yeah, so there's that bit. And then if we look at it for using the Prufrock identity, DuPont's identity, using the Prufrock company, then we end up looking like this, and the return on equity, we get that 18.06%. But as you can see, you can get it either doing a direct calculation like we did, or looking at each of those pieces, because you can look at each of those across a particular industry, right? And then you can see like, well, yeah, our return on equity is the same as our peer, but our profit margin's way higher. Their total asset turnover is way higher. So we're really good on our profit margins, but we seem to have a lot of idle assets, and they're using every single asset they have. So it lets you see where some weaknesses may exist and where your strengths are. Another thing that we'll talk about a lot is growth, and we'll talk about these growth rates and stuff. So first, let's just talk about when we talk about growing, where that comes from. And normally the first thing we look at is internal growth, right? And that's based on the income that we're generating minus all of the income that we're paying out. So if we're paying dividends, obviously we can't grow with that money, but after we've paid dividends, any money that's left, that's going to be money that we're going to be able to use to grow. Okay. And so once we come up with that, we know what our dividend payout ratio is, and this is just to show you the numbers using that same example. And then again, this is just another way of looking at that retention ratio. So, right. So here's what's going to happen. So there's two different ways we can grow. The internal growth rate, which is this one right here, is saying we're only going to fund ourselves internally, right? I'm not going to go out and issue debt. I'm not going to go out and issue any equity. What I'm going to do is just grow based on the assets that we have, right? And so our debt is going to remain stable the entire time. And so that internal growth rate is the return on assets times the amount of money we're keeping divided by 1 minus return on assets times the amount of money we're keeping, right? So ROA times the retention, and is in both the numerator and denominator, but that's how that works, right? And so that's the fastest we can grow without having to go to outside capital markets. If we can go to outside capital markets, then the fastest we can grow is what's known as sustainable growth rate. And what we're saying is we're going to keep the proportion of the company that's in debt, we're going to maintain that. So if we're 25% debt, as we grow, we're going to keep it 25% debt, right? And instead of using ROA as we did before, right, return on assets, since we're going to be able to use all of this, we're going to use ROE, right? Because we're going to be able to go out and take out more debt, right? So so it's going to be the same type of calculation, but we're using ROE instead. And you see the sustainable growth rate is higher than the internal growth rate. Right, and that's going to be happen. Now you can grow faster than the sustainable growth rate, but not forever. Right, so if you're growing faster than that, that means you're taking on more debt, and so your debt ratio is growing. Right, you're taking on more and more debt, and eventually people are going to just stop loaning you money. Right, so there would be a limit necessarily anytime you're trying to grow by borrowing more and more money. Right, so. But those are the two numbers we're going to focus on, is the internal growth and then the sustainable growth. And then as far as where did this growth come from, we've already talked about the DuPont formula. So profit margin is how well you're able to take sales and turn them into profit, right? Total asset turnover, am I able to take my assets and turn those into sales, right? And then the leverage, by getting the perfect debt ratio. We're going to talk later about weighted average cost of capital. So once we're able to get our capital the cheapest that we possibly can, that financial leverage is going to help us grow. So let's see. And then there's just some comparisons here. Like this is Amazon and Alibaba, and then you can see profit margins, total asset turnover, and equity multiplier. So Amazon, you saw the profit margins were really low. So basically they're selling stuff, close to cost, right? I mean, because there are a lot of, not a lot's making it through. However, that total asset turnover, I mean, they are able to generate a lot of sales. They don't have, I can't remember when they bought Whole Foods, but they didn't have a lot of brick and mortar, at least in 15 and 16. I can't remember exactly when they bought Whole Foods, but even after that, in fact, that might be in 2017, which is why that total asset turnover dropped a bit. But without brick and mortar and things like that, they were able to really generate a lot of sales off of those assets. So even though the profit margin was low, their equity by having the equity multiplier high, their ROE went up. So Alibaba doesn't have the same level of debt, so they don't have that same equity multiplier, and they're not nearly as good at turning over assets. I don't know what their structure looks like though internationally, so they may have a lot of storefronts or something like that, but the profit margin that they have on individual sales are huge. So they have really large markups and they're able to generate a whole lot of profit. It's just they have a lot more idle assets and their equity multiplier is much lower. And so even though ROE looks pretty similar between the two, they got there very different ways. So, and then I'm going to kind of wrap up talking a little bit more about this type of analysis. So, why do we do this? It's just a good way of doing a checkup. Every quarter, just kind of look over to your firm and you have a really good sense for how things are changing. You can compare, what we did last year to what we did this year, get some plans for how to go forward in the future. As far as like investors and creditors, suppliers using it, a lot of times it's just because they're going to extend credit. Like a supplier normally will always normally will extend credit to you, right? So they're going to make deliveries and you'll pay them, in 30 days or 90 days. And so they want to watch, for their customers to know like, well, times may be getting tough. This may be a bigger issue. So other people will watch this as well. But Shareholders do. So every time the quarterly reports come out and the annual report comes out, there's always a lot of credit or stock market activity because the investors get very concerned. Okay, so as far as benchmarking, it's really this is where things get really tricky, because we can calculate these ratios, and if I say, hey, your profitability is 7.2, was that good or bad? We don't know. We looked at Alibaba and Amazon, and that would have been really high for Alibaba, and it would have been really low for Amazon. So you have to have some way of comparing. So a lot of times with a company, the easiest comparison is to yourself. So look over the last several years and just see how those numbers have changed. If you have similar companies, you can use those. Just to let you know, if you Google like the SIC codes or NAICS codes, these are like the sectors and the industries as defined. I think SIC, the SIC codes, I think those are Department of Labor, and I'm not sure about the other one, but it's just a way that we sort of agreed, okay, hey, this is a good way to group these. I think the NAICS has a bit more granularity in it, but yeah, so that's just a way to try to find a company to make sure you're comparing yourself with someone that's proper. But some of the problems doing financial analysis is things like conglomerates. So if you're looking at Disney, I don't know who's comparable to Disney. They own movie studios, right? They make movies, but they also make television shows, right? They own ABC and ESPN, so they have sports. They have theme parks. They have just a lot of real estate because Disney owns resorts and a lot of beach towns. I think they have a place in Branson where they have like timeshare stuff that's controlled by Disney Corporation, part of their real estate investments. So yeah, when you're looking at that kind of a company, it's really hard to know exactly who to compare it to. And then these are just other little differences that can happen, the accounting procedures, fiscal year ends, things like that. It's just really hard to compare. Sometimes it's hard to compare a company to itself through time even. But yeah, so it's not perfect. It's not sort of this panacea, but it is just a way for you to go and get a sense for this. So, but yeah, that's like I said, mostly a review of what you probably did in accounting, but just wanted to give you that as well.